listen. So we're going to be talking about DC. So here we go. So here's the trade we're talking about today. So this is a Qs. We're staying in the Qs. And this is a double calendar that you can both put on Wednesdays, but you can also put on Mondays. And we are doing that in this trade. We're opening it Mondays and Wednesdays. And we're opening the trade at 3:30 p.m. The whole premise of this is we want to build confidence for people who have small accounts, who are just now getting into trading, who SPX, that it's just too big a product for them. And so they want to start small. And so this is a test where you can start small, but as you can see, it doesn't mean necessarily that the trade has to be bad. In fact, these are good trades, we would argue. And so what are we looking at here? We're looking at Q's double calendar. That's the put is a 20 delta, 2-day out. So you're every Monday, Wednesday at 3:30, you're selling a 20 delta 2-day out put, and you're buying the same strike 7 days out. So this one's a little weird. It's a 2-7. It's not any of these 1-2s or 2-4s or anything like that. We've got a little bit of time between these spreads. You have 3 guardrails. You are exiting the trade the day of expiration. So if it's Monday, expiration's Wednesday. If it's Wednesday, expiration's Friday. You're closing it at 3:30 because we do not want to get assigned 4 million shares of Q. We are exiting when the stop loss ratio is 0.1. We'll talk more about stop loss ratio another day, but basically it is your short premium divided by your long premium. It's a way of trying to make sure that you're getting enough juice in the shorts. And if you don't know what that means, that's okay. We've got tons of videos on this stuff. You can look through it. But in short, when you see short loss ratios, short long ratio, it's shorts ratio divided by the long ratio. And then exit using leg deltas. Let's look at those leg deltas real quick. So this is a 20 delta, and we're exiting when it goes above 70 delta, which that means it's going to be in the money. But we talked about this yesterday. It's okay sometimes for these things to be in the money, depending on where we're at in the life of the trade. You don't want it to be anywhere near the money when you first put this on. As time passes, and I would argue maybe when T+1 is getting pretty close, you want to, when expiration is getting pretty close, you want it to move towards these strikes. The 15 delta call, you're going to get out when you're below 60, the negative 60 delta. We've got $1 for opening, and then slippage, we're assuming 1 cent getting in, 2 cent getting out. That could be wrong. And people have commented on this saying, well, that's not conservative enough. Could be. It could be. You would have to play around with this. And I would argue with automation, eventually what you'll get is if you monitor the spreads and you monitor the slippage, you'll get a good accurate one. Then you can go back and test. And that's the way we encourage people to do it. Dan, first thoughts about this.
Yeah, a couple thoughts here. First, when you talk about a double calendar 2-7, and you could think of what comes to your mind. When would you do something like that? What are your thoughts on it? Part of what comes to my mind on a 2-7 is, when would I do a 2-7, or when would I like a 2-7? Obviously, it's a little more expensive when you do a 2-7, and I would tend to be a little more excited to have more room between the long and the short when the implied volatilities are lower, or just lower in the range. It could be right now we're in a high range, right? The current VIX, we're in a higher range, like 2022, 17, 18 is in the higher range of this higher range.
To your point about IV. Now, we're not showing the leg IVs in this, but the VIX, I'll use VIX as a proxy to get to your point a little bit. You can see here, let's use this. This is the opening VIX price, okay, for this trade in February of this year. And VIX was 1586. And so this spread cost you about $1.87 to put on when the VIX was 15. Right. Let's go up to the extreme here.
Yeah.
I go back one. Where's it good? 48. This was put on when VIX was 48. You're paying $5.66 for that spread.
Yeah.
And that's just going to show you that when vols are, this is not just unique to calendars. Obviously, if you're selling a condor, When VIX is 48, that's a lot different than when VIX is 15.
Yeah.
But because you're long Vega, to Dan's point, you are nervous in high VIX environments that it will not stick, because the moment it doesn't stick, you're in trouble with that high vol.
Well, if it sticks, it's euphoria. So
But if it's,
how do
well,
you, what an experience.
and
It's like
in,
water rafting or something. You're
absolutely.
like,
And in this case, if you see here, it's stuck.
yeah,
Vol was up actually when you took it off. And so that worked out quite well for you. This one's even better to show in that point. You
oh
opened
yeah,
this for 319, VIX was at 32. You got out when VIX was 39. So that's a big vol expansion.
oh yeah.
And you did really well. To the point of what Dan's talking about here, we put it on when VIX is 34. We got out when VIX was 30. And as you can see, that was a loser. What's happening? Well, vol's getting sucked out, and that's not good for your long Vega trade.
No, and if you look at Troy, you brought up a good point. I was just thinking, if you look at VIX today, it looks like VIX is going to be opening up around 19 or a little higher, which makes sense. S is down a bit, going near the 5,900 level again. But when you look at, if you look at to me and you said, hey, what do you think about the prospect of double calendars through July? If someone said to me, and I would say, okay, let's look at the next 2 months. The next 2 months, and isn't there a lot of tariff stuff that comes due in July?
For
July
sure.
is historically a big earnings. I would say the prospects of double calendars, some of those mixed month spreads are above average over the next 2 months. If someone said why, I'd say because I'm looking at the volatility in the range comparing it to 2022, when the range in VIX is maybe most of the year 18 to 31. I think maybe the low somewhere around 16 and a half, at least through the next 2 months. But if you said to me the high, I don't know, 30, it could be 35, could be lower, but I think we're not that far off. Sure, anything can happen, but I don't think we're going to 12 or 15. So if you're in a scenario where it's basically you don't have that much volatility risk, your double calendars are going to look good from a volatility, and the break evens are just going to get wider. And so it overall is going to be a good experience. Does it mean you're going to win every trade? No, but again, you're doing a high probability trade with the vols staying. You're not so worried about a massive volatility crush. So I think in
Yeah.
Qs or SPY or ES, and I wish there was more liquidity choice, or not
Yeah.
ES, SPX, choice,
XSP.
XSP. That's the, anyways. But it's, what do you say in the drawdown on this one, Troy?
Oh, so this is what I was showing to the point of yesterday. I think it's always good to test it uncapped too. So we had tested it with one contract max. This is what happens if you, with all due respect,
Yeah.
we're not smart. And you said, I'm going to put all of my eggs in this basket. Theoretically, and again, theoretically, it's very important because it's not reality.
Yeah.
That's a good differentiation. You would do fine, but you would do fine if you could stomach a 76% drawdown. And that's sizing is important. But I like to show those just to show
Sure.
this doesn't turn negative the higher percentage you get. And that's just a sign of a good trade. Then it just gets to the question of, can you stomach a drawdown? But have a great trading day.
Thanks, you too, Troy.
And we will talk to you guys tomorrow.